Apple's shares are down approximately 3% on the day, and on a 52-week basis, the company's shares are down by a third in value. So the question is, has the bleeding stopped? Are we at a point now where we should be considering buying these securities, or is there more pain ahead? That's what I'm going to analyze and cover in this video. So guys, as you smash that like button, let me run that intro. What's up guys, and welcome back to the channel. And you guys already know I love doing research. I love sharing what I'm seeing, but once again, this is never investment advice, so just keep that in mind as you watch any of my videos. Now let's dive into what's happening with Apple. So you can see here that the shares are actually down 3% today, which was a big decline for the first trading day of the year. And of course, since the share ran up in sort of like August and September, they are now 17% lower from that sort of like bear market surge, I guess you want to call that. And of course, on a 52-week basis, because you can see I have 1 year queued up here, you can see that the shares are down a third in value, or almost a third in value. So the question becomes, what's causing the share price decline? Well, I saw a Financial Times article today that sort of tried to describe it, and I'll add on to the article. So you can see in the Financial Times, now the first thing is they actually mentioned a pretty interesting statistic. So it really speaks to the moat that Apple has. So notice that they shipped 14% of all smartphones globally. However, they accounted for 43% of all revenues and 82% of all profits, and so it's their highest profit share since 2015. So that's really speaking to the fact that not only is Apple a strong brand, and they have been a strong brand in the smartphone space, in fact they essentially, you can argue they created it, but they're also continuing to maintain their dominance in the smartphone space. And it makes a lot of sense because Apple really makes these products that makes it easy for people to use the smartphone. And so it makes a lot of sense that they're still remaining with high profit margins and they still continue to grow out their revenues. But once again, if you're ever looking for an example of a company with a strong moat, you can really see it here with Apple's profit margins and revenue growth rates. But notice in the article, they did say that the threat to Apple's production came, as a result of Beijing loosening their strict COVID restrictions. And of course, that means that, people could be sick. And so they might not be able to produce at these, Foxconn facilities, etc. But I don't think that's the real issue. I think the real issue is the fact that people have forecasted high expectations for growth rates into the valuation models that they're using to justify Apple's share price at, greater than $200 per share, or, close to that $200 per share mark. Now, I'm not just going to say that without showing you the data. You guys know how we do it on this channel. And so I'm going to provide you with a completely detailed analysis using all of the segments in the models to sort of explain this. So this is that model that the Patreons get access to at that lower tier. Now, the one thing that I want to point out to you guys, if you haven't seen this already, is notice that Apple's revenue on average growth rate grew at double digits, obviously lower double digits, but 11.5%. And it's not the Mac, it's not the iPad, it's definitely not the iPhone that's causing these high levels of growth rate. What's causing that high level of growth rate is the fact that it's basically a services led story. So they 10x'd their services revenue from $8 billion, or 4.6% of total revenues in 2014, to $80 billion, or 20% of total revenues by 2022. So the growth story in Apple is the fact that more and more people are using services. And as you can imagine, some of these services probably have really high gross profit margins as well. And so you're not only getting it on the top line, but you're also getting it on the bottom line as well. So the question is, do you expect to forecast out a 32% CAGR into 2022? Or should we be thinking about sort of reducing our growth expectations for Apple? Well, I take the position that we probably should be reducing that growth expectation. And so that's what I do in this next slide. So you can see, here's my forecast. You see 2023 and beyond. And notice that I'm forecasting revenue to decline to just a 5% growth rate. And the reason why revenue is declining to a 5% growth rate is, notice that I'm not really taking iPhone that much lower than its, on average growth rate. I'm not taking Mac or the wearables that much lower than what they're currently growing at either. I think mid-single digits is fine for these these segments of the overall revenue pie. What I'm doing is I'm really bringing down services, because the point is that I think, and it's just my opinion, that if you're selling if you're only increasing iPhone sales by 5% year over year, eventually the services growth rate will probably decline to that level unless you're, expanding huge new services, which I just don't think they're doing. I know they're doing Apple TV. I'm assuming that falls into here, but I just don't see huge catalysts for growth here. You guys might see something else that I'm not seeing. Let me know in the comments below. Now, the other thing that I'd want to point out that a lot of people are missing is that in addition to the high growth rates and revenues that people are forecasting out, they might also be forecasting out higher gross profit margins. And the reason why I bring that up is because in 2022, they reached a gross profit margin, which is a record level for them. And so I obviously brought it down to 40% going out. And so the question I have is, if we're entering a recession and, there might be slowing sales, especially in China, as the Western world impacts or gets into a recession, then the question is, should we be forecasting out record gross profit margins? I just don't think it makes sense. And so I brought that gross profit margin down to 40%. Now, some of you might say 43%, 40%. What's the difference? Well, 3% on growing revenue really does make a difference to the valuation. And so I focus on not just top line growth, but I do focus on profitability for the company as a whole. And the other thing that I would want to point out is that some of you might mention that, if you're trying to forecast out conservatism, why wouldn't you forecast out a lower gross profit margin? Why wouldn't you go to 37.5 or 35%? And I would say for those of you who are forecasting that out, you're not wrong in doing so. You might actually end up being right, especially in the short term. But the reason why I'm forecasting out 40% is because I believe, on average, they will maintain that level of gross profit margin. And you can see in the previous slide that on average they've kind of hit 40%, and so I'm going to forecast out using that rate. But then of course the other thing that I do just to ensure a strong margin of safety is I won't buy it until I'm buying it at approximately 50% of its intrinsic value. And so that's how, we describe that as a margin of safety in value investing. That's how I take it to sort of like reduce risk further. Now, what does all that mean in relation to what I think the company's worth? Now, remember, guys, this isn't a target price for you to go out and action against. This is just what my thoughts are on what the company's worth. And this is just me sharing my research. But once again, do your own research, right? But look, I think that there's a less of a possibility that the share price continues to decline as fast as the share price currently has been since, it was at that $150 per share level. I think the company's worth around $110 per share. So, it still has a little bit ways to go before it hits that fair value. But, can you say that Apple trading at 20 times earnings, which is what the current share price is, reflects fair value? I think you could argue that, especially if you're growing revenue at a rate higher than mine, or if you're forecasting out profitability a bit higher than mine, or if you're not forecasting a multiple contraction. Because notice I'm saying that by the end of year 10, which is my model, I'm saying that the valuation of the multiple goes down from where it is currently at 20.5 times earnings to around 15 times earnings. But, you guys could argue that the multiple will remain at 20 times earnings, so you're just going to get a higher valuation. So there's a lot of things that could cause you to have a higher valuation than mine. Now, I want you guys to let me know what you think the valuation is for Apple and where I think, or where you think I might have gotten it wrong. If you haven't modeled out Apple and you want an example of how sort of like I modeled it out, you can get access to all of my research, not just Apple, but Alphabet, Facebook, Meta, Nvidia, Tesla, all of the names that I've mentioned on this channel, I have models for, which you can get access to all of that at the lower tier of the Patreon. And if you want to join us, in fact, we have a call this Saturday, you can join us at that upper tier. Now, I just mentioned Tesla. If you do want access to that video where I completely broke out Tesla and where I think Tesla is worth, at least in my opinion, you can get access to that video right here.